Welcome back to the Cygnet Capital Podcast, a discussion for sophisticated and wholesale investors navigating the ASX and broader financial markets. Last week, we were joined by Rob Watkins from Carnaby Resources regarding Carnaby's interesting progression at its Greater Duchess project. We highlighted the companies that stood out to us, including Bioxin, Aureka, and Great Boulder Resources, and we walked through a few names that we think the market may still be undervaluing in Tigers with Spots. In this episode, we'll run through a quick commodities update, hear Andrew's take on Central Petroleum and Beetaloo Energy Australia. We will also update our watch list. We're joined today by Brad Sampson, CEO of Savannah Goldfields. We'll be diving into the progression at Georgetown as the operation transitions into a steady state production. As always, I'm joined by Jonathan Rosham, John Cathcart, David McGlashan, and Andrew Machaka. But before we get into it, I must give the general advice warning. A reminder that everything we discuss today is general in nature and doesn't constitute as personal or financial advice. Please do your own research or speak to a licensed advisor before making investment decisions. Past performance is not an indication of future outcomes or results. Cygnet Capital is an authorised representative of Cygnet Securities Australia Pty Ltd, AFSL 241095. Cygnet Capital and its employees may hold shares in some or all of the companies discussed in today's episode. Jonathan, much happening over the last week?
Yes, we've been very busy. Obviously, the market is still jumping around a bit and paying very close attention to what's going over there in the Straits of Hormuz, et cetera, et cetera. So has been interesting looking at a lot of companies as per usual.
John, I hear you've been in New Zealand.
Mainly for holidays, but any of our investors that haven't been there, I thoroughly recommend it. It's a land of milk and honey. The people are exceptionally friendly. The food is tremendous. And I was up in both Auckland, Rotorua and the Bay of Islands, which is just spectacular. So not a stock tip, but a travel tip.
And John, how about the parking inspectors over there?
Well, I took Ubers, so it wasn't a problem.
Very good.
Sounds lovely, John. David, you've been in Adelaide for Gather Round. How did you enjoy it?
Well, I actually went to Adelaide for the Rising Stars Conference, which precedes Gather Round, but I did stay for a couple of footy matches, and I think the Collingwood team's looking pretty hard to beat this year.
Thanks for the plug, David. I appreciate that. We need all the help we can get.
I've got to say, if he's saying Collingwood are hard to beat, he hasn't watched many teams play.
Yes, it's very competitive in this room.
Andrew, anything exciting the past week?
Well, like Jonathan, I've been watching the markets, and you saw the inflation number come out of the US, which is kind of the runoff of the Straits issues. But we've also been looking at more companies and transitioning into a services review, which I'm really excited about.
Over to you, Jonathan.
Yeah, thanks, Sienna. Well, I got some interesting news, guys. The podcast seems to be getting out there a little bit. So a friend of mine picked me up very early the other morning, Ryan Gale, GBA Capital, son of Chris Gale, Latin Resources. Yes. Good friend of mine picked me up the other morning and he said, "Can you be quiet, please? I'm listening to this podcast." I said, "Is that right? What podcast?" And he turned it on and there we were talking.
Fantastic.
And he actually turned around to me and said, "This is more informative of some of the other rubbish that's out there." So we are getting out there and I'm glad to hear that some of this content being enjoyed by a lot of people. So thank you, Gale Force. I think I beat him on that morning, but I hope you continue to listen to the podcast with others on your way to golf and around about in the car.
Only this morning I was recommending our interview with Carnaby Resources MD to a friend of mine. You couldn't get a more thorough and more contemporary review of the company.
And absolutely, we've got a guest on every week. And this week we've got a very interesting guest, one of our Tigers. So we're looking forward to having a chat with him a little bit later in the show. So the weekly commodity update. Well, the macro overview is a start. The recent ceasefire has failed to significantly reduce the tensions, obviously in the Strait of Hormuz, which remains critical for energy and, for that matter, other materials. I mean, they're talking now about sulfuric acid and all sorts of different things. So they're going to have to resolve that. But the market is telling you that it's likely that these conversations are going on in the background with a drop of oil back under $100. But let's just see what happens. It's going to be interesting. I think the volatility's probably died down a bit and the market, certainly the bond market, may be moving on from this conflict, but still tensions remain high, and we need a resolution, but it may not come immediately, but the market's hoping it does come soon. In relation to the sectors, we've got gold and silver. We've still got a bullish feel about those. I mean, gold and silver have both rebounded from the lows. We've obviously seen in the last week the oil price come down, and as a consequence, the gold and silver prices have gone up. So positioning, I think core exposure remains justified. We've got favourable longer-term movements. We think that this is a situation where the gold and silver price are starting to form a base. They're starting to consolidate after a period of volatility, and we're hoping that over the course of the next 3 to 6 months, they're going to be higher. Obviously, oil and gas have had a pretty volatile time, and they're going to be pretty much short term anyway. They're going to be driven by the Middle East risk premium. So while the escalation risk is probably reduced, supply security remains unsolved, keeping volatility elevated for the short term anyway. So we move on to uranium. We're actually quietly bullish there. Structurally, it's intact. Uranium edged higher to about 85 a pound, while oil obviously came down. Highlights a relative strength in the longer term. The demand drivers are obviously pretty much what they've been for a while: energy security, reactor restarts, SMRs, and AI linked to power demand. We've spoken about that in the past, where the AI data centres are going to have to generate their own energy. Copper remains bullish. Immediate and structural deficits. We saw copper rise more than 3% in a session the other night, dominated by falling oil prices and geopolitical noise. We've seen copper up again last night. The move signals ongoing physical tightness and supply inelasticity. Obviously, we've spoken about Dr. Copper being a bit of a proxy on world growth, but it's more than that now. Copper is a critical metal in relation to a lot of other build-out, including things like electrification, grid expansion, the energy transition. So obviously positioning there for a strong period ahead in terms of copper. So we move on really now to a scenario where we continue to watch what's going on. We've said that we're hoping that this scenario tends to calm itself down over a period of weeks, not months. And it's only been 5 or 6 weeks in the conflict. Yes, we've all lived through it. We don't like the volatility really, and we hope that it gets resolved, but we're still only 5 or 6 weeks in. We're hoping in 5 or 6 weeks' time things will return to fundamentals, and stocks will be valued more on that than the volatility and the fear that's been in the market thus far. But anyway, we're moving on to the topics of the week, and obviously oil and gas has been in demand, and Andrew's been looking at a number of oil and gas companies, and I've joined him in those endeavours. So he's going to run through a few that look interesting.
Obviously, our review of the sector has been timely, and one thing to say, Jonathan, is that yes, most things will resume post the conflict. However, there has been some capacity taken out of the market, particularly on the LNG side, which is an opportunity for Australian producers to fill the gap. So, and that perhaps takes away from the domestic. So we've got two interesting stories we're going to talk to you about. So one is Central Petroleum, but both of them involved in Northern Australia. So Central Petroleum and Beetaloo Energy. So Central is a gas producer. It's come at a time of structural gas scarcity in the Northern Territory and a tightening East Coast gas market. Recent strategic actions materially improve the production viability, downside protection, and embedded upside. So let's think about what this opportunity provides. Conditional multi-year gas sales agreement secured, firm gas production from the Palm Valley project through to 2034, increasing contracted volumes to about 21 petajoules, which is around 11 petajoules net to Central. And just for your benefit, the gas pricing there is CPI linked. They've got 2 more wells to come in the second half of this year to increase their production. And for your benefit, they're currently producing or generating between $18 and $20 million of cash flow from their operations. And post-May, once they free up an existing contract or at least an overlift position, they'll be adding another 2 terajoules a day. So there's an opportunity for these guys to grow together with the additional wells into 2027.
And what's the market cap, Andrew?
Market cap of the company is around $70 million. So compared to a lot of other businesses out there that are generating profits, cash flows, buying back stock, it's a really attractive story.
Sounds good. So bottom line is nice exposure, got some cash flow there, and we're looking for some re-rate potential in the short term.
And we've spent most of our time talking about the key project, but they've also farmed in some acreage in Victoria and South Australia, which gives them optionality.
No worries. Now, Beetaloo Energy, that's one we both looked at this week as well. Now, they've just raised some money as well, but looking really interesting in terms of potential LNG.
The basin is really heating up. Both themselves and Tamboran raised over $300 million in the last week just to demonstrate how hot that market is. These guys are transitioning into production, which we expect in the fourth quarter of this calendar year, and that is underpinned by the capital raise they undertook and expanded debt facilities. They currently have 3 million net acres on a 100% ownership basis in both the Beetaloo and the MacArthur Basin. They have 1.6 TCF of contingent gas and estimates of over 46 TCS of prospective resource with low CO2. So as an opportunity set, it's huge. They did raise $66 million via an institutional placement, 28 cents. It's currently trading around 30 cents. They have an SPP for a further 5 mil. So they are well funded, particularly on the back of the expanded debt facilities, to fund both a testing program for one of their recently completed horizontal wells, as well as the development for their infrastructure.
From a macro perspective, Australian LNG is, I think, going to come more into favour with what's been going in the Middle East supply side wise, especially exporting it up into Asia. They're going to want our LNG for security of supply. So I think that these companies that are leveraged to exporting LNG, especially out of Darwin and potentially out of Queensland as well, are going to be well in demand. So we're going to keep an eye on this sector very closely because there could be significant re-rates on its way. So Dave, you've been over in Adelaide.
Yes, attending the Rising Stars Conference, which ran late last week. We heard from about 27, 28 companies. I think my sort of overall takeaway is there's a lot of would-be gold producers out there. They've all got 500,000 ounces, 1 million ounces, but they're not in production. They're all trying to get into production. Some of them will probably make it, but I think the value is difficult to find at the moment. In the pullback from this trouble in the Middle East has had an interesting impact on two of the bigger companies who both presented over there. Chalice, who's got the big PGM project in Western Australia, and Centaurus Metals, who's got nickel in Brazil. Both of those companies have been pretty fully valued for a long time, but have come back in the recent trouble in the last 6 weeks. Both of them, I suspect, will get developed. There's a couple of years of funding and building for each of them, but I think if you're looking for exposure to big long-term projects, there's a couple of ideas there.
Anything on the more speculative side with drilling and discoveries, Dave?
I think on the speculative side, the things that looked interesting were actually in the uranium space. A small producer in the US, Peninsula Energy, that's building itself back up after a series of setbacks in recent years. They'll build up to 600,000 pounds this year, but they've got capacity to go to a couple of million and an opportunity to extend that to 3 million. And the other one is a little company called Greenvale Energy, who are really an explorer in the territory. They've got some pretty good grades in their early hits. And in addition to their uranium, they have a torbanite project, which turns out you can process for bitumen. And at the moment, Australia imports 100% of its bitumen requirements from the Middle East, and I suspect India and maybe Malaysia. But there's a company there with a project in Queensland that might start making homegrown bitumen, which would be good for all our potholes.
Goodness gracious me, we like to go off the beaten track, but I've never really thought much about bitumen, Dave, but we'll have a look anyway, nonetheless.
It's just another outcome of not having refining capacity in market. So sadly, once you shut down 7 refineries, that's what you get, lack of product.
So big hits.
That's a big hit.
Jonathan, what are our big hits this week?
All right, well, our big hits, so PolarX, location, Caribou Dome up there in Alaska, as well as in Nevada as well. We had a chat with them yesterday, John. They had some results of 13.23% copper at Caribou Dome, but also in relation to some work they've been doing in Nevada. John, any comments?
Well, 13.2% copper is exceptionally high. So that's a very good sign. It's the fact that it's multiple, thick, repeatable intercepts says that you've got a significant deposit here, and it's shallow. It's from surface to less than 280 metres.
Absolutely. And not only that, there's some interesting results they've come out with recently there in Nevada, John, silver gold.
Yes, well, Nevada, that's the home of silver and gold. So we'll just wait and see how they develop that project, but very encouraging.
No worries. Moving on to Apollo Minerals now. So Apollo's got an interesting project there, tungsten project over there in southern France. I'm sure a couple of the guys here would like to go there on a site visit. So they've recently come up with some historical intercepts of 5.3% tungsten, multiple thick high-grade intervals, and their share price is starting to move. Also, interestingly enough, Ian Middlemas, very successful entrepreneur, been involved with Terra Metals. I think he's the major shareholder and chairman, another company that we've followed very closely. Certainly someone to watch and follow in the market, but he's got further releases coming out in relation to this project in Europe, and tungsten is becoming a significant critical mineral, obviously. Flynn Gold down there in Tasmania, they got the Silver King mine, the Henty Silver Lead Zinc project near Zeehan in Western Tasmania. That's sort of home of a lot of polymetallic deposits and tin, John.
It's a whole belt through that part of Tasmania. What we like is that Tasmania is a particularly pro-mining state. It's very important for their economy. So there's massive government support for any projects. So we're watching Flynn closely.
Yeah, and final one we're keeping an eye on that's gone quite well in the market is OD6 Metals, a fluorspar project in Nevada as well. Their initial channel sampling at the Mammoth Prospect has confirmed continuous ultra-grade high fluorspar mineralisation across an exposed breccia. John, tell us about fluorspar.
Well, fluorspar is the mineral that you get fluorine out of, which is used in a whole number of industrial processes. It's relatively rare, so it's high value. I think it's going to be a pretty exciting story. Again, in Nevada, great spot for mining, very easy to get permitting there. So we're going to watch this one quite closely, but we like the fact that it's a rare element.
Yeah, absolutely. So we're going to look out for some more detailed geological and structural mapping. Obviously, they've got some results coming out in relation to permitting and commencement of their maiden drilling program, and they are getting a lot of interest in the market based upon their critical minerals. So, again, leverage to AI chips, batteries, nuclear fuels, defence and aerospace. So we will watch that one with interest. But moving on now to a tiger, where we've discussed tigers with spots, haven't we, Andrew? They're companies that are 5 to 10 times potential or more in our view. And we have mentioned this one a few times, and we'll mention it again because we have the great pleasure of having Brad Sampson today, the Managing Director of Savannah Goldfields. And like I've said in the past, Savannah is definitely a company that we would consider one to have tigers with spots. When we first looked at it, I'd have to say it had measles or chicken pox. And that's no disrespect to Brad because he wasn't there at the time. But certainly they had problems with some flooding that took place and almost put the company under. And they've had to go about a number of different avenues to keep the company afloat. And as a consequence, they've got a large convertible note still outstanding. But the good thing is they've got the company back into production, producing cash flow, and got that plant at Georgetown up and operating basically at capacity. So I think the market has probably formed the view that they need a relatively significant amount of capital to get Agate Creek back into production. I'm not convinced that that's the case, and Brad is here to tell us more about the story and give us an update as to why the market's probably overlooked Savannah. So basically, under conservative assumptions, we think that Savannah can generate $7 to $8 million worth of operating cash in the next few months prior to Agate Creek getting back into production. And clearing the convertible note, it looks like a really difficult task at the moment. But if you listen to Brad talk through the restart of Agate Creek, hopefully you'll see what we can, and that convertible note becomes very manageable. So it's with great pleasure we've got Brad on the line. Brad, over to you, mate.
Thanks, Jonathan. Appreciate the chance to be on your podcast. It's pretty exciting for me. I might start with just a little bit of the history and then lead into what the next few months look like, because at the tail end of last year, we got into restarting operations, restarting the gold plant and making gold. Originally, we're going to get the plant up and running for 2 months, and we've been able to continue to produce gold right through the Christmas period, through January and February. In March, we shut down for some maintenance, and then we've just restarted the gold plant again post-maintenance, and we now have enough feed to run continuously through until we get access back into Agate Creek. And I'll come back to Agate Creek later on, but that's really important because we have significant ore reserves at Agate Creek. So over the next few months, we expect to continue to produce gold. There will inevitably be some more minor maintenance shutdowns at various times, but the plan over the next few months is continue to operate the gold plant, continue to produce gold, and you'll see us move through mining at Big Reef and then into mining at Agate Creek. And that's really important for us because we've gone from being sitting there not producing any gold, initially going to get up and running for a short period. Now we're back to continuous operations, and once we have access to Agate Creek, we expect to be from Agate Creek ore reserves. That gives us more than a 2-year processing runway straight away. So, Jonathan, you and I had some conversations about margins and 6,500 or 7,000 Australian dollar gold price and all-in sustaining costs of a bit over $3,000 an ounce. This operation can generate very meaningful cash flows from a plant that does about 200,000 tonnes per annum. So It's a small plant, but it can generate a lot of cash.
Sorry, Brad, just a question there that we've sort of brought up in here as well. With Georgetown being the only plant within 400 or 500 k's of that town, there's a lot of stranded deposits there, and it just opens up the opportunity effectively for Savannah to do toll treatment opportunities with potentially some higher grade stranded deposits to create more cash flow and fill that mill and obviously produce at a very, very good margin. So could you talk a little bit about the strategy of the Georgetown mill and what you're doing in relation to perhaps some of those stranded deposits up there?
Absolutely, Jonathan. And obviously, with a 2.5-year processing runway in front of us right now, that's great. We've got long cash generation potential in front of us, but we've got our own growth story, and I'm sure we'll come back to that in a moment. But we can supplement that with toll treating opportunities, and some of those toll treating opportunities may lead to significant growth as well. And we have an operating gold plant. We're the only operating gold plant within about a 400-kilometre radius by road. And there are literally hundreds of small-scale claims in the area. There are people, everything from one guy with an excavator through to significant ASX-listed exploration companies. And at the small end of it, there's an opportunity to provide a few weeks, a few months worth of feed, and some of those things may lead into acquisitions of ground. And many of those are already on mining licenses, so they can be brought into production quite quickly, and we've already tested one of those. And then there are ASX listed exploration companies that at some point, if they're going to realise value for their shareholders, need to move towards production and either build their own plants or toll treat through ours. And we think there's a very clear business case for those explorers to get early cash flows in a non-dilutive way for their shareholders by processing through our plant. And we're pretty excited by those opportunities.
No problem. And look, let's move on to Agate Creek, because Agate Creek's a pretty substantial deposit, historically been mined at, cash costs of less than 2,000. It's high grade. You know that there's at least 35,000 odd ounces there, which extrapolates out to a lot of cash flow. What are the last things that need to be ticked off or completed before you can bring that into production? And can you give us some timing and what steady state production might look like from Agate Creek and how long that might go for without any growth prospects there either?
Yeah, thanks, Jonathan. Agate Creek, you're right. It's very important for the company. The company's previously produced gold from Agate Creek through 3 different gold plants, including the Georgetown plant. So in terms of the time frame to be back up and running, we're expecting to be resuming mining from Agate Creek in June, and we'd like to be putting first ores through the gold plant in August from Agate Creek. To be able to do that, we obviously need to have an updated environmental permit issued by DETSI in Queensland, so that's the Department of Environment here in Queensland. And we submitted our application for that environmental permit last year. We're in dialogue with DETSI on that now, and we have every expectation that somewhere in May we'll receive that permit, and therefore we believe we're on track to resume mining in June. And mining contractors lined up, haulage contractors are lined up. There isn't much for us to do now, Jonathan, except get that permit and get into action on the site.
Well, that's got to be a significant re-rate opportunity for Savannah shares. I mean, that's obviously the market's looking towards that as being the catalyst that potentially looks to pay off the convertible notes, which are due sort of later in the year, that are, for those who don't know, there are large convertible notes out there. They were put in place when the company was going through its troubles around when they had the flooding, etc. Wes Maz and Steve Bizzle, both on the board, both prominent business people, are controlling that, also major shareholders. So we don't necessarily see it as being a major default issue. I think they're in relatively friendly hands, but I think they're certainly overhanging the market, and Agate Creek becomes the cash flow engine that can pay those off. Is that the plan, Brad?
Yes, Jonathan, it is. And Agate Creek's really important for that, because the average grade of those ore reserves is like 2.65 grams per tonne. The first ore we mine from Agate Creek is slightly lower, and then we finish at slightly higher grades. But over the life, the couple of years of processing from Agate Creek, we're processing an average of 2.65 grams per tonne. That's more than a gram more than we've been processing so far. Obviously we'd expect higher margins, significantly more gold production, generate cash over a long period of time than to square up those convertible notes.
And so the capacity through the mill is, somewhere around that, let's talk ounces, somewhere around that 1,200 to 1,500 ounces a month, at cash costs of, let's call it 3,000. You're making pretty significant money every month to go towards the repayment of the convertible notes.
That's right, and that's exactly right. And we've always recognised the cash generation potential of Agate Creek, and it's a very important part of the story, and it creates the foundation for our future growth as well.
And tell us about the growth at Agate Creek, drilling-wise, for the resource.
It's an interesting one. We've got ore reserves already defined at Agate Creek, and that we will truck back to the Georgetown plant for processing. Around that, there's another 15 million tonnes of lower grade mineralisation that at these gold prices, we don't think makes sense to truck back to Agate Creek. So we're in the process of planning now for a feasibility study on building a plant at Agate Creek. So a larger, probably in the order of 1 million tonne per annum gold plant at Agate Creek that would then unlock the value in those 15 million tonnes of mineral resource that's sitting there. And beyond that, there are a number of other growth prospects that have got me even more excited, Jonathan. Electric Light and Red Dam to the north, and our sulphide stories. So at Electric Light and Red Dam, we we undertook some exploration drilling just before the wet season last year. So finished that as the rains started, and initially what we were trying to do was validate some historic results and set us up to be able to go back there this year and drill more. But the results we got from Electrolyte and Red Dam were hugely exciting. So they're both north of the Georgetown processing plant. They have been historic mining there. There is potential along strike of the historic open pits for oxide mineralisation, and then the majority of the drilling that we did last year was into the sulphide zone, which is sort of starts 20 metres below surface, and have spectacular intersections at Red Dam. We've got really spectacular grades in a thinner vertical mineralisation, and electric light, very wide mineralised, gold mineralised zone, more than 10 metres thick, and grades up around 5 grams per tonne at Agate Creek. At Electric Light. So both of those are shaping up as having real open pit potential along strike, open pit potential into the sulphide zone, and I'm getting excited about the potential for underground mines from both of those, and they both have potential to significantly extend the processing life at the Georgetown plant.
Just in terms of the sulphides, Brad, you have to put in a flotation circuit. Capital costs might be 3 to 5 million. John, what does that mean in terms of production potential for Savannah going forward?
Well, the sulphide resource, you're quite right, doesn't go through the existing plant, but a flotation circuit is quite easy to add on. So your crushing and grinding circuit is all able to be used for both circuits. So I'd say a relatively modest capex. It's not a big plant at 200,000 tonnes per annum. The building of the 1 million plant at Agate Creek's the next growth phase, Brad, for this company, isn't it?
I think I'm pursuing both options at the moment, gents, because they're all exciting, and I think they offer some different possibilities for us. And I don't know which one yet gets developed first, but the Agate Creek expansion is very exciting, and we have people working with us now on that. We have groups working with us who are interested in providing some technology that can add value to the project and some financing. The reason I want to, a key reason I want to progress the sulphide project in parallel with it is that there actually is some potential to put sulphide material through our cyanide circuit, the CIP plant at Georgetown, and historically, that material has the historic test work has demonstrated that we can achieve combined gravity and cyanidation recoveries in the sulphides of better than 70%. We've got samples of core in the laboratory now. We're waiting for them to finish their metallurgical test work because we've wanted to get additional data points on Red Dam and Electric Light because we think there's upside on that. And you might say, well, even if you can get 80% recovery, that's still not fantastic compared to what 95 or 96% you'd get in a float circuit or the sorts of recoveries you'd normally get from cyanidation of oxide material. But the importance of it is that we have a gold plant sitting there. We have a 200,000 tonne per annum gold plant sitting in Georgetown.
The other point you're making, which is critical, is that your capex is relatively low just by bolting on that circuit.
That's exactly right. There's potentially opportunity for almost zero capex to be processing sulphide. So that's exactly right.
Brad, market cap of the company around 30 million. Shares are back to the price you basically did the capital raising at. Obviously, Cygnet and Bell Potter helped you with a $15 million raising back 6 or 9 months or so ago now. They've come back, obviously, with the market. Obviously, convertible notes we've spoken about are a bit of an issue. But like I said, we expect that the company will generate significant revenue and margins, and Agate Creek back into production provides the cash flow to pay off the note. What do you think the market is missing and potentially still misunderstanding about Savannah that you can possibly clear up?
First thing, Jonathan, is I don't think the convertible notes are an issue. I just don't think there's any immediate stress caused by those convertible notes, and we have a plan to generate the cash to service that. So I think that, other than some perceptions, I just don't see that as a real issue. We'll deal with that in due course. And then what I think the market doesn't yet fully understand, and this is the reason why I joined the company, they're the same thing. It's the growth potential of this company. And and the exploration, in part, the exploration potential of the area that we're in. There are literally hundreds of gold occurrences in the area that have been scored, hundreds of little open pit mines into the oxide zones. There are gold mineralised sulphide zones underneath all of those. They've got Agate Creek as part of this big gold mineralised system. It looks like there are parallel structures next door to it. We're 60 kilometres west of the old Kidston mine. We're 300 kilometres north of Charters Towers. We're in a really exciting part of the world for gold, and it's underexplored, and there's an enormous opportunity. We've got the cash generating machine. We've got a gold plant sitting right in the middle of it. We've got it up and running, and as we get into Agate Creek, we stabilise the cash generation of the business, and that creates a foundation for growth. And that, to me, is the really exciting part of the story.
Brad, I'd just like to comment. I think one of the reasons the market's overlooking you is that you don't have a large published resource. So when the search engines have a look at you, they just say, oh, they haven't got much. But we can see the potential that you've got is absolutely huge. And as you say, you're a cash-generating machine. So well done. I think it's a great story.
Yeah, thank you. Appreciate the chance to be on your podcast, Jonathan.
No, well, that's a pleasure, Brad. So, look, we'd like you to hang around. We're going to continue on with the show, and we might come back to you for some expert comments and see what else potentially you might know that we don't.
Thank you. I'll be here.
All right, now moving on to our watch list.
Yeah, so we're holding 500,000 Somerset. We paid 1.7 cents. They're trading at 1.9. They're currently drilling. We think that drilling is material in its impact if successful, so we're keeping a very close eye on Somerset. Terra Metals, we've got 30,000 shares in Terra Metals. They're trading along well. The other week they came out with an announcement saying they've got sulphides, visuals in the sulphides again, John.
Terra Metals, we think this should be valued against the feeder-style magnetic sulphide systems. We get continuity of massive sulphides and a very decent plumbing system. It's not isolated to high grades, but certainly we see that there. This drives the valuation, and as they find more high grade, we expect a step change. At the current stage, it's only being valued at $20 to $50 per platinum equivalent metals, and we expect this to re-rate a possible doubling to $60 to $100 per ounce, and therefore a materially higher market value. Upcoming drilling, if it confirms the continuity of the feeder system and the plumbing architecture, we expect that this will be quite a significant discovery.
Thank you, John. And we also had a chat with our friend Bernard this week on Ioneer. So boron's actually starting to become a strategic product for the US defence, and this company is trading at a significant discount compared to a lot of the other lithium projects out there, and I think it's because the market thinks they're not going to be funded, which I don't agree with, but the funder, I think, is going to be a government. It's either going to be the US, Korea, or perhaps Japan, or maybe a combination of all three. And also on the watch list, we've got Barton Gold that's transitioning itself into a near-term producer under a similar hub-and-spoke strategy that our friends at Savannah are employing. So they're leveraging a fully permitted processing plant and multi-large gold silver assets in the Gawler Craton and to deliver early cash flow and sustainable growth, not to mention the fact that they've come up with a very interesting silver potential discovery that offers very significant optionality.
The Barton Gold guys are progressing on a number of different fronts. The silver is certainly going to add value to them. They've got an early startup opportunity to process about 300,000 ounces of gold that should fund the full development of their Tunkillia project, and I think that's starting to look pretty interesting.
Yeah, absolutely. And Carnaby, who we've had on the show in recent weeks, is entering into a very interesting point in its development with shortly going into production, potentially later on in the year. So it's pretty much entering into that zone where it could potentially become a target of a merger or some sort of transaction as they enter into that cash flow generation type scenario, not to mention the fact they've got a lot of drilling results that are due to come out. And John, Broken Hill, we bought a few of those in the portfolio a couple of weeks ago at 80 cents. You have been out to the Rasp mine and Pinnacles out there in Broken Hill.
It's was the largest historical silver lead zinc mine in the world. BHP walked away and left an enormous amount of what they termed low-grade material behind when they closed it. This is now exceptionally economic grade material now, and Broken Hill Mines have picked that up. They also have the Pinnacle mine about 15 kilometres away with an operating plant that can be expanded. So it's a two-trick pony, one of the great silver lead zinc deposits. The town and government are right behind it. We think Broken Hill Mines is severely undervalued, and when the cash starts coming, I think shareholders will be very well rewarded.
And our friends at Ballymore can't take a trick. I spoke to Ballymore last week, about to get on the ground at Torpies to start drilling, and guess what? Another cyclone comes through. Unbelievable. They just cannot take a trick, and unfortunately the share price, like a lot of their other friends in Queensland, have been absolutely pummeled because they just can't get on the ground. So, again, we've said that doesn't change what they've actually got. It just changes the ability for them to actually get active and start making news. So we'll still, obviously, we love Ballymore, but they just can't take a trick at the minute, but their shares are significantly undervalued. LinQ offers highly leveraged exposure to district scale gold and copper in the Macquarie Arc. We're watching them. They're well off their last capital raising price, so we're still looking for an opportunity there. Aureka we discussed last week, as we did Hamelin Gold, and of course Savannah we discussed today in the meeting with Brad. Brad, coming back to you, is there anything else we should be putting on the watch list to keep an eye on?
Yeah, Jonathan, there are two that I've been watching a lot in recent times. One you just called out, Ballymore. I'm pretty excited by the work that they're doing, and David and I worked together in Ross Mining a long time ago, so I know that he knows the area well. But he's in that same part of North Queensland that we're in. It's heavily mineralised, underexplored, and he's onto some really exciting things there in Ballymore. The other one that's not too far away from them, and very similar sort of story, is Cygnet Metals. So again, they're in the Charters Towers to Townsville area, highly mineralised, multiple different deposits of copper, gold and base metals. So I think a hugely exciting story that's worth a look at.
Yeah, they're a very good story as well, and I think well backed by Lion Selection Group. Hedley Widdop, who is a very smart investor in the gold space, obviously well known in Australia. And our final one on our watch list this week is Rumble Resources. We really like Rumble Resources. I don't think the market's quite looked at the tungsten potential there. So we're still doing our work on Rumble. We've mentioned them before. We are continuing to look there, and we will update everyone when we're finished with those reviews. But that's pretty much the end of our show this week. I'd like to thank Brad Sampson of Savannah joining us today, one of our tigers with spots. Hopefully those measles and chicken pox and everything we've discussed in the past that aren't too complimentary are going to start to turn into a beautiful company in the not too distant future. We think that certainly they've been overlooked by the market, and there's a lot of potential upside to come there, and they'll fulfil the potential of a tiger. John, back from New Zealand, obviously back working hard again in the next couple of weeks, Johnny?
Yes, this is a critical time, sort of mid-quarter, that we like to contact the companies, see how they're going, general ring around, and see if we can pick up on anything that they're up to.
And Dave, back from Adelaide, are you going on any other site visits or any conferences coming up?
Nothing in the immediate short term, but a fair bit to work through from Adelaide.
And Andrew, still working hard as usual?
Plenty to do. There's a lot of companies that look really exciting, and we'll be able to talk more about it in the coming weeks.
Yeah, and Sienna, obviously with the market going the way it is, we haven't had too much luck for our charity, but we're working for the McGrath Foundation for the rest of the year with the view that we're going to send you to Sydney Cricket Ground for the pink test to hand them over a nice big cheque, which would be really good. And we're still working hard to get that result for them. So over and out for this week. We're going to be having a show a week for the next 2 or 3 weeks. So we're going to be very active and coming up with a lot more interesting content for you all. But for this week, signing out. And again, thank you very much to Brad.
Thanks, Jonathan, for having me. Greatly appreciate the opportunity.
Thank you for tuning in to this week's episode of the Cygnet Capital Podcast. A reminder that everything we discuss today is general in nature and doesn't constitute as personal or financial advice. Please do your own research or speak to a licensed advisor before making investment decisions. Past performance is not an indication of future outcomes or results. Cygnet Capital is an authorised representative of Cygnet Securities Australia, Pty Ltd, AFSL 241095. Cygnet Capital and its employees may hold shares in some or all of the companies discussed in today's episode. We'll catch you next week for more on the markets.